If you're looking at the price of gold right now and thinking about hitting the buy button, take your hand off the mouse immediately. You're about to step straight into a liquidity pit built specifically to hunt retail stop losses. There's one massive danger zone and one hidden contrarian opportunity in play today. I'm going to break both down for you, and if you stay until the end, I'll give you the exact invalidation level that can flip this entire gold market upside down. Welcome back to Alpha Market Meridian. We've got an extremely tense setup unfolding in gold right now. Price is hovering right above a trapdoor, and retail trader sentiment is dangerously bullish, all because of mainstream financial headlines. But the institutional order flow I'm tracking is telling an entirely different story. Right now, gold is sitting at 4,735.61. Let me be clear, this is not a safe buy entry. This level is nothing more than a magnet for mass liquidations. Write this key level down right now, 46.63. This is your critical session invalidation level. If we close below the 4,663 zone today, the entire bullish structure we followed is officially dead. We'll be staring down a sharp, vertical correction that will catch every complacent long position completely off guard. The clear bias for this session is to fade rallies, not chase breakouts, and we are still trapped inside a range until that key level breaks. Our play is to sell overextended premium levels, not buy fake breakout momentum. Let's break down the full technical structure, because this chart is laying out a perfect bearish snare. Start with the weekly time frame. We've enjoyed a strong bullish trend, no question, but price is now stretched drastically far above the 20-week moving average. That moving average acts like a gravitational pull. Price always reverts back to it eventually, and the current separation is creating extreme rubber band tension ready to snap. Drop down to the daily chart, and the setup gets even more dangerous for bulls. The 200-day moving average is still sloping upward, holding the macro long-term floor. But the 60-day moving average is starting to flatten directly around 4,674. This is a major pivotal zone. We are currently trading above the 20-day moving average, which has flipped from support into short-term dynamic resistance. Gold is severely overextended here. The daily MACD is printing a clear bearish curl. Buyers are completely exhausted. The histogram is making lower highs, confirming bullish momentum is bleeding out even as price creeps toward new highs. The 4-hour chart is where the trap is fully being constructed. Watch the 4,734.20 resistance level closely. Price briefly probed above it to hit 4,735, but look at the 4-hour MACD, textbook negative divergence. Price made a higher high, yet the momentum oscillator made a lower high. That tells you the bullish engine is failing from within. The 60-period moving average on the 4-hour time frame is curling downward, actively rejecting higher prices. For precise execution, switch to the 60-minute chart. We are chopping around the 20-period moving average and respecting a clear descending trend line. The market is technically range-bound, but that range is heavily tilted to the downside. Let me clarify the key support levels. 46.63 is the major structural breakout invalidation level. The immediate intraday trapdoor trigger sits at 4,674.55. A 60-minute candle closing below this level will open the floodgates toward 46.63, and then into a deep bearish zone. Here's what most retail traders completely miss. They see price knocking on 47.35 and instantly fixate on a bullish breakout. They ignore the cross-asset narrative that screaming gold is due for a sharp pause. We have to analyze gold, the fear asset, alongside crude oil and the US dollar index. Crude oil is still holding a huge geopolitical risk premium. Without immediate military supply shock escalation, oil will consolidate or roll over, stripping the inflation premium straight out of gold pricing. The US dollar index is stabilizing right at major support. Even a minor dead cat bounce in the dollar will act as a wrecking ball for gold bulls. The market is pricing in an aggressive Fed dovish pivot that may never materialize, and gold has front-run this narrative to an unsustainable extreme. The bond market tells the unfiltered truth here. Real yields are not collapsing nearly enough to justify gold trading at 47.35. This is pure sentiment-driven blow-off. Action, not fundamental fair value repricing. Those mainstream headlines telling you to buy gold on pullbacks? That's not a bull signal. It's institutional liquidity grabbing. Smart money uses retail headline hype to offload positions into eager retail buying pressure. My 1 to 2 week directional bias is clear. Gold is due for a correction back toward the 4,600 handle. The only event that invalidates this bearish thesis is immediate confirmed military escalation, sending Brent crude soaring above $100 overnight. Without that geopolitical shock, this overbought condition has to resolve to the downside. We are fading every overextended premium rally. Most viewers will click away when they hear a bearish take in a strong bull trend, but this is exactly where smart money builds profitable positions. Stay locked in for clear entry strategies. Let's break down 3 actionable trading strategies to navigate this gold trap. Strategy 1. The sniper, conservative confirmation play. This is the patient approach, waiting for the trap to fully trigger before entering. No early guessing, no premature entries. The trigger, a 60-minute candle close below 4,674.55. Not just a wick, a solid closing break with volume confirmation. Set a sell stop at 46.73. Stop loss placed at 46.85. This 12-point buffer protects you from fake breakdown algorithm stop hunts. Target 1, 46.50, a major round number psychological support zone where dip buyers will step in. Target 2, 46.10, filling the liquidity gap from the recent pivotal swing low. This setup delivers a clean 1-to-4 risk-reward ratio, perfect asymmetric value play. The setup is completely voidated if price reclaims 4,690 immediately. That signals structural buying pressure is still dominant, and you step aside. Let's engage with the community right now. Pause this video for a moment. Drop your gold expected trading range for tomorrow in the comments. Do you see price holding 4,700 to 4,730, or a break below 4,674? I'm reading every comment to see who's trading objectively, not emotionally. Strategy 2. The active trader, mean reversion sell at resistance for active traders already positioned or looking to sell the overextended trap zone directly. Entry condition. Sell on a pullback into the 4,735 trap resistance zone, only on clear bearish rejection. Place a limit sell order at 47.33. Tight stop loss at 47.42. Just above the session high and the 47.35 psychological barrier. The logic is simple. If price breaks cleanly above this trap zone, the bearish setup fails, and you don't want to be caught short. Target 1, 4,700 major round level. Once target 1 hits, move your stop loss to break even immediately. Never let a winning trade turn into a losing one. Target 2, 4,680 intraday pivot zone, capturing the full core of the bearish move. Rule to follow. Lock in a 15-point trailing stop once target 1 is hit. Trade by rules, not emotion. Take note of the commitment of traders positioning right now. Market participants are extremely long gold. When everyone piles onto the same side of the trade, the market always flushes out the crowd. That's the hidden opportunity inside this 47.35 trap. Strategy 3. The aggressor, high-risk fade play strictly for experienced traders who manage small losses and aggressive position sizing. We fade the intraday vertical spike directly. Entry. Market sell execution at 47.35 only on a sharp 5-minute chart wick rejection. Never enter on a slow grind higher. Only enter on obvious bullish momentum failure. Scalpers tight stop loss at 4,740, just 5 points of defined risk. This is a high-reward wrecking ball trade. It delivers massive returns if it triggers, but you will get stopped out frequently if algorithms hunt obvious liquidity. Target 1, 47.10, a quick 25-point scalp. Target 2, 46.95, chasing momentum against the short-term bullish trend, treating the 4,735 spike as pure liquidity grab. Critical warning. If a 5-minute candle closes above 4,738 with heavy volume, your bearish thesis is instantly wrong. Do not average down. Exit immediately. Always watch the US dollar index alongside this trade. A sudden dollar drop will run straight through your stop loss. Quick risk management reminder. Never risk more than 1 to 2% of your trading capital on any single setup. High impact news is scheduled for tomorrow. Use hard fixed stop losses. No mental stops. No exceptions. To wrap this up, burn this level into your screen. 46.74 is gold's fault line. If this support crumbles, the bullish narrative is suspended, and we trade liquidation downside. Ignore the mainstream headlines, trade the actual chart and institutional order flow. Tomorrow we dive deep into the US dollar index and S&P 500 divergence, the master key controlling the entire risk asset complex right now. If you want to know whether a dollar breakdown could unexpectedly rescue gold bulls, the linked video is waiting for you on the end screen. Never trade these assets in isolation. Smash the like button if this analysis gave you a clear plan to avoid getting trapped at 47.35. Subscribe and hit the notification bell. We cover 8 critical market assets every single day before heavy institutional volume enters the market. I'll see you in the next analysis, and always stay sharp.